We are back. Sam Seder on the Majority Report on the phone. It is a pleasure to welcome to the program Rana Foroohar. She is an editor with Time Magazine.
I am assistant managing editor, and I'm also the economic columnist at Time.
And also author of Makers and Takers, The Rise of Finance and the Fall of American Business. Rana, welcome to the program.
Thank you so much for having me.
So this is this book covers the ground, which I think is sort of like the central issue, not just of this campaign, although I think it really, in many respects, has been in one form or another. But I think it's has been the central fulcrum of our politics for almost 10 years now. I mean, in terms of like level of awareness.
Yes.
And so let's just start with the sort of the low hanging fruit. Makers and takers. This is not Mitt Romney's makers and takers.
This is not Mitt Romney and Paul Ryan. No, in fact, the title of the book came to me. I was doing the backstroke in a lake in New Hampshire, of all places, and I was thinking about that. It was around the 2012 election cycle that first Paul Ryan and then Mitt Romney used the word takers to describe people who were not paying income tax. I mean, because they were too poor to pay income tax or didn't have jobs in many cases. That wasn't part of the message. But this idea that these people were taking, and that the capitalists, the hedge funders, the people at the top of the sort of capitalist food chain were making. And it was very puzzling to me because at that point, like all financial journalists, I had been really studying this huge divide between Wall Street and Main Street, which had been in evidence for several decades, but really, really came, as you say, into the public attention sharply following the financial crisis, at which point, of course, we had the Great Recession, and then you had the Fed coming in and providing a lot of monetary stimulus, which put the markets to all-time record highs, but Main Street was still stagnating. So I thought, wait a minute, who are the makers and who are the takers, really? And I began to dig into what was wrong with the financial markets, and what I found was really that the market paradigm that we have come to trust, this idea that the markets are supposed to take all of our money, that banks are supposed to take all of our savings and funnel them to productive investment in businesses that are going to grow the economy, that wasn't happening. So the killer stat in my book is that only 15% of all the financial flows coming out of the big U.S. financial institutions are going into business investment. The rest of it is going into this closed financial loop of trading, of speculation, of lending against existing assets, stocks, bonds, houses. And so it's enriching basically the richest percentage of the population without actually creating real underlying growth. So that's where my title, Makers and Takers, The Rise of Finance and the Fall of American Business, comes from. And I hope it will go some way towards rebranding those terms.
And we can see, I mean, just like a sort of an easy expression of that sort of dichotomy, I guess, is we're looking at a stock market that is nearing all-time highs, if it's not quite there, and an economy that has been mired in incredibly slow growth and growth that seems to be even slowing at this point. And we've still seen the same issue in terms of productivity or the gap between wages and productivity. I mean, all the markers of what the so-called real economy is doing is sort of seems untethered from what's happening in financial markets.
Well, that's right. And, it's funny, you're putting me in mind of a conversation I had right after the fall of Lehman Brothers about 8 years ago. I called up a friend and a source of mine, a guy named Steve Roach, who is a professor at Yale now. He had been the chief economist of Morgan Stanley, very smart guy. And I said to him, all right, explain to me what just happened, with the fall of Lehman and the collapse of the financial, what is going on? And he said, the markets have become unmoored from Main Street. And I thought that was quite profound because nobody else was making that point at that stage. And as I began to dig into my book, I found that is absolutely the case, that financial markets are now completely untethered from what's happening in Main Street. And you can see that in all of the data points that you're mentioning, but it has to do with two things. It has to do with the growth in size of the financial system to the exclusion of everything else. So a couple of statistics that kind of illustrate that. The financial system in America creates 4% of jobs. It takes 25% of corporate profits. So that is a tremendous amount of economic oxygen being sucked out of the room. And the other thing that's important is this shift that I mentioned where the business model of banking, this, not to be too cliche, but this sort of It's a Wonderful Life model of banking where banks take our savings and funnel the capital to productive uses, that's broken. That's not what the financial system does anymore. The financial system trades against existing assets, creates asset bubbles. It is not, by and large, about productive lending to Main Street.
In some ways, it's all basically side bets, right? I mean, if the game is
indeed,
if the game is the people sitting at the table, these are just people who are just sort of like watching the game and betting on what's going to happen, and their money never ends up in the pockets of the people sitting at the table. I mean, there was also one. So we have this situation where, how do we measure? Because then I want to get into sort of some of the more of the specifics. But how do we measure what the size of the financial sector is at this point? Because it seems to me that this has become like it's harder and harder to measure what is a real company versus what is part of the financial sector today, right? Because it can appear to be a real company, but that's not where they're making their money.
Well, that's right. And in fact, I was quite conservative, actually, in my estimates. I took basically federal statistics that would tally up the size of the formal banking sector. So, the JP Morgans, the Wells Fargos, the Citibanks, as well as the insurance sector, the mortgage market, certain real estate trusts. I didn't count in all of that shadow banking, private equity, hedge funds. I mean, that's a totally different area. And frankly, it's very, very hard to track because those things are largely unregulated and difficult to even see. And many of them are offshored in terms of location. And that's about 7% of the economy. That has more than doubled over the last 40 years. But there's a whole other aspect of this. And this is, I think, kind of what you're hinting at, that real businesses in every industry are more and more acting like banks. And one of the really stunning things that I found is that if you look from 1980 till now, companies of all stripes, airline companies, manufacturers, high-tech companies are getting 5 times as much of their revenue from just moving money around. So you get, for example, transportation companies that are big into oil hedging, and they're not just hedging their own bets, they're in the trading and speculation part of the business. You get all this tax optimization, a company like Pfizer trying to relocate overseas so it doesn't have to pay U.S. taxes. You get companies offering financial services, offering loans and debts to customers to buy their own products. So that's a whole nother vast part of our economy that is just revolving all around finance.
I mean, so is there any measure of that? I mean, because, let's say, I don't know at this point, and I want to get to GM because, I think, but just as an example, and I don't know the specifics breakdown, but let's say, 20% of GM's revenue, they might be higher, just comes from GM lending to buy their product. And so, does that figure in? Because, I guess I asked because in the back of my head, I remember interviewing Jared Diamond, I think years ago on his book Collapse, and him saying like, there is a number where societies collapse when financialization becomes a big enough part of their economy.
That's right. And guess what? We're pushing that number. I mean, it's fascinating because a lot of big institutions, the IMF, the World Bank, the Bank of International Settlements, have all done studies about how the size of finance affects the underlying growth in an economy. And what they have found is when finance gets to be even half the size that it is in the U.S. right now, you start to see slower growth. So we have pushed well beyond that phase. And then there's the sort of counter problem of the bigger finance gets, the more financial crises you have, and the closer together they're spaced. So we used to get crises of the kind that we saw in 2008 once every 30 years. Now they're coming once every 15 years. There are very smart people that think we're probably looking at once every 8 or 10 years now for this kind of event because finance has become so big. And those sorts of crises, aside from wars or natural disasters, they're the biggest destroyers of growth on the planet.
So talk about like how would too much finance
Mm.
inhibit growth? I mean, and people should understand when we're talking about growth here, we're talking about making of products, we're talking about
Yes.
wages and wages rising so that
Yes.
so I mean,
So that people can have more money in their pockets to
right.
spend, which then so there's several ways in which this works. One of the first ways is that, as I said earlier, the basic business model of banks lending to business is broken. You see this effect in small and mid-sized businesses, many of which have shortfalls of capital. Now, small and mid-sized businesses make up about 60% of the job creation in this country. So if they can't grow, job creation is broken. There's another way in which this plays out. As finance has gotten bigger and everything has begun to revolve around the markets, our entire society really, from our 401ks to the way in which business education is run, there's a cultural shift, and we all began to look at the markets as a sense of our well-being rather than saying, hey, what's really going on Main Street? And this issue of credit and companies, you mentioned GM, offering loans to people to buy their products. Well, one of the reasons they have to do that is that no one has gotten a raise in real terms since the early 1990s, and many working class people and minorities haven't gotten a raise since the early 1970s. So policymakers, and I cover this in chapter 1 of my book, policymakers, rather than looking at that problem and saying, wow, what can we really do to help Main Street growth? They sort of pushed the ball to the financial markets and to finance and said, let's offer people more credit. And in fact, there's a wonderful quote by Professor Raghuram Rajan, who is now the central banker of India. He used to be at the University of Chicago. And he was one of the preeminent seers of the 2008 crisis. And he said it's almost like we have the term let them eat credit, in a Marie Antoinette kind of way, so that we can distract people from this underlying problem in the real economy. Would just give them more and more credit to mask the fact that nobody is actually getting raises. And ultimately, when you have an economy like we do in the U.S. that is 70% consumer spending, if you don't get a raise at some point, the math stops working.
Right. All right. Well, so and I want to jump into the sort of some of these examples that you cite in your book. But first, I mean, is there a way to sort of like cleanly quantify how much of the problem is a function of banks on one hand, which seem to be very uninterested in the vanilla, loaning to a specific community and helping people's business, which supposedly is too risky, is why they don't loan. But of course, they eschew that for basically going to the casino.
Right. Other things that are more profitable, but equally, if not more risky.
Right. And so how do you draw the line between that dynamic and then this other dynamic, which really interests me, and we mentioned on the phone before we got on that you cite Bill Lazonick, who we've had on this program a couple of times over the years, his work in the relationship between shareholder empowerment, if you will, and how it inhibits basically companies from being companies as we understand them. Draw that line for me, and then let's go look at that sort of that company sector.
Sure. So I think of this in terms of sort of concentric circles. So at the very center, you've got the too big to fail banks, and we've talked about that. They're just operating in a very dysfunctional way. Then around that, you've got everybody's money and how it works within the financial system that we have. So we have a privatized 401k system, which I argue has not served the majority of Americans well. You have tax policy that subsidizes the debt that encourages financial institutions to do the bad stuff and not the good stuff. You have housing policy that basically creates bubbles and also encourages debt. And then in the next concentric circle, you start to get to this thing you're talking about and that Bill Lazonick is so articulate about, which is how corporate behavior is being perverted by the financial markets. And what he talks about, and I actually quote him and use his numbers in my book, what he talks about is how companies are now under so much pressure from Wall Street to jack up share prices and create more value quarter on quarter, regardless of what that does to underlying growth, that they can't make good decisions that actually help them 5, 10, 20 years down the line to create real prosperity and put more money in workers' pockets and thus enrich local ecosystems. Instead, they're forced to just jack up profits quarter by quarter. Now, how have they been doing that lately? They've been doing something called share buybacks. And share buybacks are when companies go out onto the open market and they buy back their own shares. And this is an artificial way to jack up the price of the stock because it decreases the number of shares on the market. Now, companies often do this historically when they have no better way to grow. So when their underlying growth is tapped out and they don't have any more great killer apps or products or ideas, they start doing these share buybacks. And that's kind of how you know that you're at a market top. Well, guess what? The last 3 years, we have seen record share buybacks. And what's even more amazing, and Lazonic writes really beautifully about this, it creates this Kafkaesque system where the companies that are most involved in the capital markets are the companies that don't need any capital. So case in point, Apple. Apple is the richest company in the history of the world, like ever. They've got about $200 billion sitting in bank accounts, many of them offshore, interestingly. So they don't want to move that money back to the U.S. and pay the corporate tax rate in the U.S. So instead, they have been borrowing over the last few years billions and billions of dollars to pay back, to buy back shares, which enriches the activist investors, people like Carl Icahn, Bill Ackman. You know, we used to call them barbarians at the gate. Now they're activists. It enriches these folks. It enriches basically the top 10% of the population that owns 80% of the stock. But it doesn't change anything in the company itself. It doesn't create a new iPod. It doesn't build a new factory. It doesn't employ more people. It creates this sort of market saccharine high of wealth, which also, by the way, increases the wealth gap. So that's this other huge circle of how the financialization of America has infected all of American business.
And isn't it not just a question of the pressure from, you know, so-called activist shareholders, but also, I mean, and I guess maybe it's sort of a bank shot in that way, but certainly all the people who would make the decision, right, to engage in a stock buyback or to say like, we're not going to spend that $200 billion on R&D. We're going to park it over there so that we have assets, so that our you know, we look good on paper. That's how they make their money too, right? Like.
Well, that's right.
I mean,
that's right. And this goes back. I mean, this is sort of a fascinating point. This goes back to some shifts that had not to do with banks, but had to do with how compensation was awarded. So back in Bill Clinton's administration, there was actually a growing concern about the wealth divide in America. And folks like Joe Stiglitz, who was in the administration for a time, were talking about this. And so there was a discussion about how should CEO pay be capped. And the administration came up with the idea that there should be a $1 million pay cap. But Bob Rubin, who was then the Treasury Secretary, argued for an exemption for, quote, performance pay that would be paid in stock options to go above that. Well, at that point, boom, you start to get this huge ramp up in the percentage of executive compensation that is paid in stock options. That continued on throughout the last 15 years or so. And so now, basically, everybody who is sitting in the C-suite and certainly in the CEO's chair is getting anywhere from 30 to 80% of their pay in stock options. So you betcha they want to do anything they can to jack up the share price.
And we should remind people, too, that while it went up slightly during the Clinton administration, the capital gains on that type of earnings had been dropped during the Reagan administration. So it was sort of like,
oh yeah, and you know, by the way, Reagan was the one under his SEC commissioner Shad. That was when stock buybacks themselves became legal. Prior to 1982, they were considered illegal market manipulation. So that just kind of shows you how far we've come.
I mean, that's sort of, it's stunning, right? Like we just keep layering these, like it's basically like we're going to create a road for you to head down towards this destination, and then we're going to pave it, and then we're going to actually put light rail on it. And it's basically just saying to all these people who are in charge of these companies, do everything. We're going to give you every incentive of the world I mean, your business is no longer going to be the business of the company. Your business
Yeah.
is going to be to get the company to look a certain way. And if it
That's right.
does, then you're going to make more money. I mean, how else could it possibly work?
That's right. And, by the way, just to connect the dots back to GM a little bit, all of this sort of manipulation, this financial engineering rather than the real kind, is being taught in American MBA programs. And one of the ways that this line of thinking became so prevalent in all the MBA programs around the country is that Robert McNamara, who was, of course, the architect of the failed Vietnam War effort, he ran Ford Motors, and he later was the dean of Harvard Business School. His very numerical, always look at the metrics, cost cut, marshal your capital to the exclusion of everything else. That philosophy worked its way into Ford via the whiz kids, into Harvard Business School, and then throughout the rest of corporate America. So you now have bean counters trumping engineers, basically, to put it sort of crudely, in corporations, and companies taking very siloed, very short-term, balance sheet-driven decisions, when in fact, oftentimes those aren't the best decisions at all. I mean, just as a counterexample, think about Steve Jobs. Think about the creation of the Apple stores. No CFO was ever going to say, hey, let's build some giant glass boxes and put, 3 products in them. I think that's going to be an awesome idea. Let's do. No CFO thinks that way. No financially engineering-oriented person thinks that way, but some great innovators do. And what I'm saying is we need to really get back to thinking about how do you build the best products and services for the economy, for customers? How do you enrich workers and local ecosystems rather than just thinking about the balance sheet?
I want to put a pin in that because I want to get to how we get to those solutions. But before we do, and there's a stat that you cite where it's really clear the implications of how much sort of the markets and these incentives are skewed between private and public companies in their explain that figure, that contrast.
Yeah, this is, I think, one of the most important stats in the book. So you hear a lot in the public debate from CEOs, from the U.S. Chamber of Commerce and the business lobby that, well, only if tax rates were lower, if only there were less red tape in America, businesses could invest and everything would be great. Well, guess what? American businesses are investing. They're just private businesses. So if you look at the private companies, and in particular family-owned companies, they invest about twice as much into Main Street as public companies do. And what that tells me is it's not the tax rate, it's not the red tape, it's the willingness to take a long view that private companies have, and the fact that they don't have to deal with that quarterly pressure from Wall Street that enables them to take those decisions. And public companies can't do it for the reasons we've discussed.
And I mean, I guess I keep seeing it from the other side is that they're not going to make any money if they don't do that.
Right.
Like,
and they might get fired too.
Right.
An average CEO in a public company has a shelf life of 3 years.
Well, but my point being that a private company, they can do all those things that they see a public company do to increase their stock value. But the problem is there's no one to pay them for that. They actually make their money based upon what their product's doing now and in 5 years from now.
Well, that's right. And, this is an important point because a lot of the competitors internationally to U.S. companies that are coming up out of China and India and Brazil and the emerging markets, they're privately held, and many of them are family owned. And they can take, not even a 5 or 10 year horizon, but a 20-year horizon, a 50-year horizon. So U.S. companies are really going to be in trouble in the next 20 years if we don't reform the way the capital market system works, because they can't compete in that environment.
All right, so let's talk about what type of reforms. I mean, if you had 3, let's make it 4. If you had 4 major reforms that you could impose because you were elected Donald Trump and have garnered all power from Congress and everything's by executive action, what would the top 3 or 4 be?
Well, I'll step back and say that the very first change I would make would be more of an existential change. I would shift the narrative. I think that we have come as a society and a culture to believe that finance is the tippy top of the pyramid, the place that we graduate to after being an agrarian economy and a manufacturing powerhouse and a services economy, that finance is sort of the top of the ladder. And I would invert that and remind people and remind my entire administration and all the lawmakers and regulators that finance exists to serve business and to serve society. And if finance can't prove that it's doing something with a clear, measurable good, then it shouldn't be doing it. Okay, so that's rule number one. Number two, I would tackle the tax code. I think that there's just a ton of low-hanging fruit there. And actually, there's some opportunity for bipartisan agreement, I think. We have a tax code that largely subsidizes debt and penalizes equity and savings, and I would flip that. I think we need to stop making it so easy for companies and consumers to lever up and start creating incentives for people that save. I mean, savers out there have been hugely penalized in the last 8 years because they're earning nothing on their money. So that would be number two. Number three is we still need a tremendous amount of transparency in the financial system, in part because the financial lobby is so big and powerful. We only got about halfway towards regulating things like derivatives, those weapons of mass financial destruction that Warren Buffett talks about. We still need to really plug some of those loopholes. And, that's something you hear people like Elizabeth Warren or Tom Honig talk a lot about. Fourth, and I may even squeeze in a fifth, we need radically different housing policy. I mean, one of my favorite chapters in the whole book is looking at how post-2008 private equity firms came in and scooped up all the distressed properties that were being sold on courthouse steps. Blackstone, a private equity firm, is now the largest single-family homeowner in America, which is why in some neighborhoods that I visited for this book, you see unemployment rates that are higher than average, and you also see rents that are higher than average. So we've got to come up with a housing policy that doesn't encourage debt, but does give the opportunity for people to get on the ladder, because housing is still where the majority of Americans keep the majority of their wealth. And then finally, and very quickly, one-fifth thing, I would say, got to reform the retirement system. The high fees being charged by the asset management industry are egregious. We've got to get people in a much more secure situation, particularly since this process of financialization has put us in an era in which I think we're going to see dramatically lower returns in the stock market going forward.
So let me ask you just about two of those questions. In terms of the housing, I mean, how would you do what you want to do in terms of housing, like from a policy standpoint?
Okay, so for starters, you need to bring all financial institutions under some of the rules that the biggest banks already have to abide by. So one of the reasons private equity was able to go in and buy up all those houses, as opposed to, say, JP Morgan or Wells Fargo, is that banks, big formal banks, actually there are rules that make it they must create certain amount of affordable housing properties. There's rules about how they can exist as players in the mortgage market. There's lots of players out there that are not bound by those rules. So we need to have an equal playing field. We need to basically stop subsidizing debt for rich people. If you look at the mortgage interest tax deduction, it largely goes to upper middle class families and basically allows people to buy McMansions, which, by the way, also bids up asset prices. So I look around at my neighborhood in Brooklyn. House prices would be half of what they are if we weren't all able to deduct large sums of money from our taxes because we have these enormous mortgages. I don't believe that that's a social good. We need to look at that system and fix it.
And in terms of the retirement, why not just increase Social Security? I mean, because it seems to me that
that's
the biggest problem
to think about.
The biggest problem we have with 401ks is that people just don't put their money in it. Right? I mean,
right. That's right. And it's a privatized system. It's a for-profit system. You've got asset managers that run these things for companies, and they encourage people to go into products that basically eat up between 30 and 60% of their nest egg. Everybody should be in an index fund. I think Social Security is great. I think that should be a huge pillar, maybe one of two or three pillars of fixing the retirement system, expanding and strengthening that.
All right. One last question. Why not curb the buybacks, and why not roll back that rule about why not curb the
compensation?
buyback? Yeah.
You definitely, that would be something to look at too. I almost think though that those other things I mentioned are more core, and once you start fixing these sort of those inner circles, then the rest of it starts to correct itself as well. So, but yeah, sure, absolutely, that's an important thing too.
Rana Foroohar, the book is Makers and Takers: The Rise of Finance and the Fall of American Business. Thanks so much for your time today. We will link to that book at majority.fm. Folks should check this out. I really do think that this is sort of like the ground zero, if you will, of the issues that we need to deal with in this country when it comes to both wealth inequality and just sort of sustainability of our economy going forward.
Really appreciate it. Thank you for having me.
Bye-bye. Hello, you. I'm Sam Seder. Looking for smart progressive talk that is occasionally amusing? Well, subscribe to our YouTube feed. Subscribe to our podcast. Like us on Facebook. And just generally enjoy us.